How's it going, everybody? I just want to do a kind of quick video talking about the buy and hold strategy for stocks. A lot of times people are wondering, what should I do? How should I buy my stocks? Should I, put all my money in one stock or multiple stocks? When should I buy my stocks? How do I know when to sell? All these types of things, you kind of want to get yourself a little system, a little strategy before you even buy your first stock. So the first thing you want to think about is, what is your goal? What do you want to do? How long do you want your money to be invested in growing? How much are you hoping to get from your investment, say in the next 5 years? What do you want to do with the money once you get it? Once it grows a certain amount, are you going to take all of it out? Or are you going to just take some of your gains out and go make a purchase? You want to plan these things out first. Once you kind of know what you want to do, how long it's going to take you to have your money invested, you want to figure out what to buy. What stocks do you want? Well, the best way you can do that is you can look up the Dow Jones Industrial. It's a list of 30 industrial companies. The Dow Jones is one of the top three stock exchanges in America. You got the Dow Jones, you got the S&P 500, and you got the NASDAQ. The NASDAQ is mostly technology. The S&P 500 is financials and some technology. And the Dow Jones, like I said before, is a lot of industrial companies. And that's the shorter of the three lists. It has 30 companies in it. So a good way to get started figuring out what stocks you would want to buy, just Google search Dow Jones 30, find the list. Just go through the list of the 30 companies in the Dow. I'll put that up on the screen. You can take a look at it. So these are a list of the 30 companies that are in the Dow Jones 30. A lot of the companies you'll see are familiar. You got Apple, Microsoft, Salesforce was just added in the last year, Visa, Procter & Gamble, Johnson & Johnson, a lot of companies that people know. A few of them you may not know. You have to do a little bit of research to find out who they are, what they do. Not every company on this list is going to be a good company that you want to buy and hold. Some companies on this list their stock value have been declining for years, year after year, but they're still so large they can remain on this list of the top 30 industrial companies in America. So you want to find the top companies, Microsoft, Apple, those type companies. Google may not be on the list, but it's one of the top companies in America. You want to find companies like this, companies with good balance sheet, good financials, a lot of cash sitting on hand. You can find that out. You can Google search things like this. How much cash does a certain company have on hand? Companies with cash, they can go through times like now, the coronavirus, without having to do layoffs and trim a lot of their services and cut back on what they provide, the value that they provide. They can just continue on as normal and just kind of work off some of the cash that they have saved up. These type of companies are going to be around for many years. They're going to be stable. They're not going to have all these ups and downs and have to restructure and all this type of stuff. So you want to look at least like their 10-year history. Reason why you want to look at a company's 10-year history to find out if it's a stock that you want to buy and hold is the Dow Jones. If you look at their 100-year chart, go back 100 years, on average, year over year, you can expect to gain 7% at least on your money if you just purchase, say, the Dow Jones 30 companies. 7% a year, year over year, long periods of time, 10, 15, 20 year periods, you're getting at least 7% on your money. Now, people might wonder, well, what happens, when the stock market crashes and when I lose all my money? Not really. You're not losing your money. What's happening is, the value of your portfolio is going down when there's a major event and the stock market, quote unquote, crashes. But you're not losing your money if you're not selling your shares. If the stock market, quote unquote, crashes, but you don't sell, you just ride it out, the value of your portfolio will go down. And during the recovery period, it will come back and it will grow even higher. So when we look at this chart from Google, I just Googled Dow Jones history and I got a chart. showing, let's see, from actually just like the 1980s through now. If I go back all the way to when we had the dot-com bubble that happened, basically when the internet was still kind of fresh, any company with a dot-com at the end of it, people just thought, oh, this is the greatest thing ever. Their stock prices are growing. I'll just jump in. They were just throwing their money into any company that ended in .com, thinking there's going to be, making millions of dollars. So that's how you create a big, huge bubble that's eventually just going to burst and cause a crash. So in the late 90s is when we had the .com crash. All right, if we look at January, year 2000, the Dow Jones Industrial Average was at about $11,000. And this is when people started kind of first realizing, wait a minute, some of these .com companies, they're not even doing anything. They don't have any operations. They have very few employees. They're not producing anything. And when they really started digging into it, there were like probably dozens of these .com companies who just opened up shell companies, had IPOs, initial public offerings for their stock, and were selling stock, and stock prices are just skyrocketing, but they're not actually producing anything. No services, no products, no nothing. So when everybody started figuring out that this is going on, that's when the stock started dropping and people started losing lots of money. So started with January 2000 through January 2003, the Dow Jones fell from 11,000 down to about $8,000. So that's a nice size drop over a year and a half period. So of course, people who are planning on retiring in this time period, they saw their 401ks and everything, their investments just going up the last few years. And then all of a sudden, they just lost like almost half their money. Now, if you're retiring right at that time period and you started taking money out, then you'd be taking money out at a loss. So you really would have been losing money. But typically, you don't just withdraw your entire 401k all at one time. You just start taking monthly checks out. Therefore, you're not really actually getting hurt as much as people were kind of hyping it up to, seem like, oh, you lost 40% of your money. You just walk away with that. Actually, you're just losing little by little over this time period. But then from 2003 to 2007, the Dow Jones went from 8,000 up to 13,000. So just in a few years, you would have recovered and gotten all that money back. So say you didn't retire, you just stayed on for another couple years, actually most of your money would have been back in your account. Or if you did choose to go ahead and retire, you would have just been taking out $2,000-$3,000 a month just to cover expenses, and that really wasn't going to be hurting you too bad. Now, 2007, what is that? That was the time period where the housing market crash was about to happen. People realized, oh, the value of all these houses being sold is too inflated. Houses that should be only selling for $500,000, selling for $700,000-$800,000, and that's because the banks were doing some fishy stuff, packaging all these bad loans together and just selling those on the open market. They had people in houses who, didn't have much income, couldn't afford to repay the loans. But if you're writing a bunch of loans, you're getting commission checks. So you're just going to keep writing loans. That caused the housing market to crash. So 2007 through 2009, Dow Jones went from 13,000 down to 7,500. Again, it's looking like, man, you done lost 40% of your money. But again, typically you're not taking out all of your money all at one time. When you retire, you just start withdrawing, taking payments once a month. So really, you're not hurting too bad. And you always just give it some time and the market always recovers. It just might take a year, 2 years, but it will recover. So you don't have to worry about if the market crashes, going to lose a whole bunch of my money. It's not lost. Your value of your account is just down, but it's going to recover and come back even higher. So you look at from February 2009, when the Dow Jones was at $7,500, through January 2013. Short time later, it's back at 13,000. Fast forward to today, October, November, coronavirus has happened. Back in February, market crashed, 35% down. Look at now, it's back where it was. Many other companies are past where they were. A lot of companies had their 30% drop with the rest of the market February, March 2020, and up through now, they recover all of that plus another 20-30%. So in the short term, things were kind of shaky. We didn't know what we're going to do. How are we going to get through the lockdowns and shutdowns and all that? Companies had to start sending people to work from home, and restaurants and bars and things had to close completely, which means they had no revenue. But your major companies that are traded on the stock exchanges, many of those companies were doing perfectly fine. They found a way to get through all of this. And now just a short few months later, the entire Dow Jones is back where it started. Individual companies within the Dow Jones are way up above where they were February 2020. So with all that being said, the time to buy is whenever you have the money. You don't have to wait for a certain time to try to, the market's really, really low. Yeah, if you do happen to catch the market low after it's taking a dip, definitely jump in. The companies that you have picked out that you know you want to invest in, you've done your research and you're comfortable with these companies, definitely, if you see the market take a downturn, jump in, buy as much of these companies as you possibly can. If the market's kind of up and you're not sure what's going to be coming next, you don't have to worry about trying to catch it at the right perfect time. Just go ahead, start to put your money in. When you get your 2-week checks or once a month, just go in. The companies that you already researched, just start to buy them. That's called dollar cost averaging. That means you don't try to wait for the lowest price possible and end up missing out on buying the stock because the stock price is going up and you're waiting to get it at a lower price. You just go ahead and buy in. Certain company might be $100 a share right now. Just go ahead and buy some of it. You see it go down to 95 or you see it up at 105. Don't try to necessarily wait for it to go from 105 back down to 95. It might not take that downturn. So just every 2 weeks, every month, just go ahead and buy in. That's your when to buy, when you plan on buying and holding. Any 10-year period that you look at the Dow Jones, for the most part, it's gotten you back. In any 10-year period that you look at over the last 100 years, it's gotten you back at least 7% a year return. There's times where it's even more. On the chart that I put together, going from January 2000, when the Dow Jones was $11,000, through November 2020, when it was up to back to 29,000, we actually started off with a big dip, with the Dow Jones going from 11,000 down to 8,000, and then going up to 13, down to 7,500, then going back up past 13, blowing past 20, all the way up to 29,000. And then during coronavirus, it dropped probably down to 17,000 and right back up, all inside of this year, 2020. So that would have been, in the last 20 years, 263%, or 13% a year. So in year 2020, had you just bought one share of the Dow Jones, or even better, selectively picked out the companies that you prefer from the Dow Jones, picked 10 out of the 30, the top 10, held those companies from year 2000 through 2020, you would have at least been getting 13% a year, probably closer to 18 to 20% a year. And that's why you can just simply buy and hold and not necessarily worry about when to jump in, and not necessarily try to time the market and jump out every time you see the market is up. Now, at the end of the time period that you do want to, hold your stocks because you have a certain purchase that you want to make, or you're going to be retiring and you're just ready to move away or something, you do want to pick a time, of course, when the stock market is up. We can just about see that every 8 to 10 years or so, there's some major downturns. Something happens. Dot-com bubble, housing market crash, coronavirus. That's the last 30 years right there. In the next few years, when the market is up, that's when you will want to go ahead and take your retirement. That's when you want to go ahead, withdraw, make the purchase that you want to make. Don't wait until we've been growing for 8 to 10 years, and then all of a sudden, at the very, very, very end of that, you wait for the market to crash and then try to sell and retire, or sell and make a purchase. If it's been going up for the last 7, 8 years, that's going to be your time to go ahead, take some money out, start enjoying some of it before the market crashes again. Well, that was a little bit longer than I expected it to be, but there's a lot of points to kind of explore, and we kind of dive in and give a little bit of information, give some backstory to the Dow Jones. So hope it was useful. Hope you got some value out of this. Got any questions? Leave them down in the comments and I'll respond. Thanks a lot for watching. Appreciate it.